Welcome to Talk Tickers. Today we're diving straight into the key takeaways from Evergy's latest earnings call.
Yeah, let's unpack what they reported and what they're signaling for the future.
Okay, so starting with the top line results for Q1.
Right. First quarter adjusted earnings per share came in at 74 FS.
74 cents. And how does that stack up against last year?
It actually matched the previous year exactly, flat year over year.
Okay, flat. But I gather there were some pushes and pulls behind that number.
Oh, absolutely. It was really a story of offsetting factors. You had a boost from the recovery of their regulated investments, but that was countered by, well, softer industrial demand and, those higher expenses we keep seeing.
Right. Expenses always seem to be a factor. Now, I did see something about retail demand being up, and it was a cold winter, wasn't it?
It was colder, yeah. Overall, retail demand climbed 2.7%, and heating degree days were up significantly, about 18%.
You think that would really juice the margins then? More usage?
You would, logically. But the margin benefit was actually pretty limited. It comes down to something called declining block pricing during the winter.
Explain that a bit.
So essentially, as customers use more electricity during those cold periods, the price they paid for each additional kilowatt hour went down. So volume up, yes, but the price per unit at the margin, not so much.
So the pricing structure kind of muted the positive impact of the cold. Were there other things impacting sales too?
Yeah, a couple of things. They mentioned sales headwinds from scaled back activity after some pretty significant snow events we had.
Okay, weather impacts again.
And also a notable unplanned outage at a major industrial customer's refinery.
Ouch. Is that back online now?
Thankfully, yes. They did say it's returned to normal operations.
Okay, good. So despite those sort of one-off hits and the pricing dynamic, they're sticking to their guns on the full-year outlook.
Seems so. They reaffirmed their full-year 2025 adjusted EPS guidance. That range is still $3.92 to $4.12.
With a midpoint of $4.02, right?
Exactly. And not just 2025. They also reaffirmed the long-term earnings growth target, that 4% to 6% range through 2029, based off that 25 midpoint.
And I thought I saw a note about potentially being towards the higher end of that range later on.
That's right. They anticipate being in the top half of that 4% to 6% range from 2026 to 2029. The potential kicker there could be landing some of these new large customers they're talking about.
Interesting. Okay, so Q1 maybe a bit mixed, but the forward look is still pretty positive. Let's dig deeper into that Q1 performance. How did all those pieces add up to 54 cents?
Sure. So if you break it down, the net impact from retail sales, volumes, pricing, and weather all combined was only about a 1-cent benefit to EPS.
Only a penny after all that volatility.
Yeah, again, that volume boost from the cold weather was pretty much washed out by the declining block pricing effect we talked about.
Okay. What else is in the mix?
Well, something maybe not immediately obvious, the leap year. Or rather, the lack of one this year compared to 2024.
Right. 2024 had the extra day in February.
Exactly. So the roll-off of that extra billing day actually dinged EPS by about 3 cents compared to Q1 last year.
Makes sense. And that industrial customer outage we mentioned.
That definitely had a negative impact, too, chipping away at the results.
Okay, so those are some drags. What were the positives pushing it up?
The big one was the recovery and return on their regulated investments. That contributed a solid 13 cents to EPS. That's sort of the core, steady part of the business doing its job.
Right, the utility basics. But investing in that infrastructure isn't free, I assume.
Definitely not. All those infrastructure investments mean higher depreciation and also higher interest expenses. Together, those reduced EPS by about 10 cents.
Okay, so 13 cents in from regulated recovery, 10 cents out for the cost of those investments.
Correct. And then you had a few other miscellaneous items that netted out to a negative impact of about 4 cents. So you add and subtract all that, and you land back at the $1.54.
A real mix of factors then. Let's pivot to the sales trends. Overall demand up 2.7%, but you mentioned weather played a big role. What does it look like if you normalize for weather?
Yeah, that's a key point. If you adjust for the weather impact, demand actually saw a decrease of about 3%.
Oh, interesting. So underlying demand was actually down?
It seems so for Q1. Residential and commercial usage was definitely boosted by the cold weather, people heating homes and buildings more.
Right.
But those snowstorms likely hampered some business activity, as we noted. And the big driver of that underlying decline was really the industrial sector.
Primarily due to that refinery shutdown.
Mostly, yes.
Yeah.
That temporary shutdown was the main culprit for the industrial weakness.
But they sound optimistic about demand for the rest of the year.
They do. They expect healthy demand growth going forward. A couple of reasons they cited. One is just steady customer growth. Their customer count is up about 1% year over year. That provides a base level of growth.
Okay, organic growth.
And the other, potentially bigger factor is the expected ramp-up of those new large customers, specifically Meta and Panasonic, primarily in the second half of 2025.
Oh, right. Those are significant energy users coming online. So even though Q1 was maybe a touchlight versus their own internal plan.
Yeah, they mentioned it was about 5 cents below expectations before they took some mitigating actions.
Okay, but despite that, they feel confident about hitting the full year $3.92 to $4.12 target.
They do. They pointed to strong underlying earnings drivers, the expected rebound in that weather-normalized demand we discussed, and the reliable revenue stream from those recovered regulated investments.
And I bet cost control is part of that equation too.
Absolutely. They specifically highlighted a focus on cost efficiencies and managing O&M operations and maintenance expenses really carefully. That's key to hitting the numbers.
Makes sense. Okay, shifting to the longer-term picture and those major investments, that $17.5 billion capital plan through 2029 is still the number.
Still the number, $17.5 billion through 2029.
How are they planning to pay for all that? It's a big chunk of change.
It's a mix. Funding is expected to come from operating cash flows, first and foremost, then issuing some debt.
Standard stuff. What about equity?
Equity is part of the plan, yes. They anticipate needing about $2.8 billion in equity or equity-like instruments, but that's weighted towards the later years, specifically between 2026 and 2029.
So, importantly, no new equity planned for 2025 itself.
Correct. Their 2025 guidance does not rely on issuing any new equity this year. The current expectation is for roughly $1.2 billion combined in 2026 and 2027.
Okay. And is that equity number set in stone, or could it change?
There's potential flexibility. They noted that if more of these large customers they're pursuing actually come online by, say, 2028, the resulting boost to operating cash flow could potentially reduce the amount of equity they need to issue.
Ah, that's a key point. So landing those big deals could lessen shareholder dilution down the road.
Potentially, yes. They did also mention they might take some preparatory steps in 2025 for future equity needs, like setting up financing facilities, but any actual stock issuance wouldn't settle before 2026 at the earliest.
Okay, that's helpful context. Now let's talk more about those demand growth opportunities. It sounds like there's quite a bit in the pipeline beyond just Meta and Panasonic.
There really is. Their current base forecast, that 2% to 3% annual demand growth through 2029, that already includes the announced large customers, Panasonic, Meta, Google.
Right. And how much load is that expected to be?
Those three alone are projected to add about 500 megawatts of new load by 2029, which is, quite significant.
But it sounds like there's potentially more stacking up behind them.
A lot more, potentially. They have customers who are currently in the finalizing agreements stage. If those come through, it could add another 600 megawatts by 2029.
Wow, so that would more than double the load from the currently announced big customers.
Exactly. If all of that materializes, they suggested total retail sales growth could potentially reach the 4% to 5% range annually through 2029.
That's a big step up from the base 2-3%.
Huge. And that still doesn't include customers they're in earlier stages of discussion with. The overall pipeline of potential growth they're tracking has now expanded to 12.2 gigawatts.
12.2 gigawatts. That's an enormous number.
It is. And encouragingly, they said 300 megawatts from that broader pipeline has recently moved into the actively building category, though that demand is expected to ramp up more from 2030 onwards.
Okay. Any really big fish that might be announced sooner?
Yes. They specifically mentioned being in final negotiations for 2 very large data center projects. Together, these represent 1.3 gigawatts of potential load.
1.3 gigawatts from just 2 projects.
That's right. They're hopeful for announcements later this year, with the actual demand heading probably between 2027 and 2028.
And beyond those 2?
They're also in advanced discussions with other customers representing approximately 3 gigawatts of load. Some of that could potentially start impacting demand as early as late 2027. So, yes, the scale of potential new demand is quite remarkable.
Truly transformative if even a good portion of that comes through. How does all this potential growth feed into their long-term planning for power generation, their IRP?
Well, the updated 2025 Integrated Resource Plan definitely reflects this higher anticipated long-term demand growth. It specifically incorporates the potential large loads that are currently in that finalizing agreements pipeline.
So the plan is already adapting. What does that mean in terms of new power plants?
It means they need more generation. The plan calls for adding roughly 2.1 gigawatts of new generation capacity between now and 2035.
Okay. And what kind of generation are they looking at? Mostly renewables.
They're describing it as an all-of-the-above strategy. So definitely includes renewables, but also natural gas generation to ensure reliability. It's about a balanced mix.
And are they actively looking for projects now?
Yes, they've issued a request for proposals, an RFP, for projects needed through 2032 to meet that planned capacity addition.
So balancing renewables, gas, reliability. Are they also adjusting plans for older plants?
It seems so. The preferred plan in the IRP includes delaying the retirement of some older generation facilities, likely coal plants, and they're also considering converting some units to natural gas. It's all part of balancing reliability, affordability, and the clean energy transition.
A complex balancing act, for sure. Now, a lot of this, the investments, the rates for big customers, hinges on regulatory approvals.
Right.
What's the latest there? Let's start with Kansas.
Okay, Kansas. The main rate case, the Kansas Central one, is moving along. They expect a final resolution there around late September.
Okay. What about specific projects?
They did reach settlement agreements on getting predetermination for partial ownership of 2 new combined cycle natural gas plants and also a new solar farm. The commission order on those is expected by July 7th, so fairly soon. That provides some certainty for those investments.
That's positive. And what about the special rate, the tariff, for those big data centers they hope to attract?
That's crucial. There's a procedural schedule set up for approving that large load power service tariff in Kansas. The aim is to reach an early settlement, but if not, there are processes for further discussion and hearings in the fall. Getting that tariff approved is really key to landing those data center deals.
Understood. How about things over in Missouri? Similar activity.
Pretty similar, yes. On the generation side, the Public Service Commission staff there has actually recommended approval for building several new generation facilities. Settlement talks and hearings for those are scheduled for this month, May.
Okay, so movement there too. And the large customer tariff in Missouri.
Same situation as Kansas, really. They've filed a request to approve a similar large load power service tariff. There's procedural schedule, settlement discussions planned, and hearings likely in the fall if needed. So parallel tracks in both states on that front.
Definitely lots for regulators to consider in both Kansas and Missouri. So wrapping up the call takeaways, what are the big strategic priorities they're really hammering home?
They boiled it down to 3 main things. First, affordability. They stressed efforts to keep the long-term trajectory of customer rates generally in line with inflation, even while making these significant investments needed for growth and reliability.
Always a tough balance. What's number 2?
Reliability, no surprise there for a utility. Focusing on strong operational metrics, grid modernization investments, and ensuring their power plants are available when needed. Core utility stuff.
Right. And the third priority?
Advancing the transition of their generation fleet. This ties back to the IRP implementing that balanced mix of resources, moving towards a more sustainable energy future while keeping the lights on and costs reasonable.
Affordability, reliability, and that balanced transition.
Got it. Okay, that brings us to our This Is Not Financial Advice segment. Based on all of this, what's an outrageous but plausible trade idea that springs to mind? Okay, outrageous but plausible idea number 1. You look at this massive potential demand growth from data centers, right? 1.3 gigawatts in final negotiation, maybe another 3 gigawatts in advanced talks.
Huge potential, yeah.
And you combine that with the possibility that landing these deals could reduce their need for future equity issuance, lessening dilution. So a speculative idea could be a long position in Evergy itself.
Betting on them landing these deals.
Essentially, yes. The bet is that securing a significant portion of this large load growth drives higher earnings and cash flow, maybe leading to upward revisions in their long-term growth targets, and the market hasn't fully priced that potential in yet.
What's the outrageous part, or the main risk?
The risk is timing and certainty. These deals aren't done deals yet. There could be delays, negotiations could fall through, or regulatory approval for those special tariffs might hit snags. It's definitely a bet on execution and a favorable environment.
Okay. Interesting idea focused on the demand upside. Got another one.
Idea number 2 is maybe a bit more complex, a paired trade. You look at their generation investment plans. The all of the above strategy means investment in both renewables and natural gas.
Right, they need both.
And you also see potential delays or rethinking around retiring older coal plants for reliability. So the trade could be go long a basket of companies that would benefit. Think natural gas producers supplying the region, maybe renewable tech providers active in Kansas and Missouri.
Okay. Long the enablers of their plan. What's the other side of the pair?
The short side could be companies heavily reliant solely on coal-fired generation, particularly those maybe less adaptable or facing more retirement pressure. You're essentially betting on Evergy's specific investment direction and the broader energy transition dynamics in their territory.
So playing the shift in generation mix, what are the risks there?
Well, regulatory decisions could always shift unexpectedly.
Right.
Maybe natural gas prices spike, making it less attractive, or new technology disrupts the plan. And pinpointing the exact winners and losers in the supply chain is always tricky. It's definitely playing a specific angle on their resource plan.
Two very different, thought-provoking ideas there. Of course, do your own homework, folks. This isn't financial advice. All right, that was our deep dive into Evergy's latest earnings call. Hopefully that gives you a much clearer picture of their recent performance and, maybe more importantly, what they see coming down the pike.
Yeah, a lot hinges on landing that potential large load growth and executing on the investment plan.
Absolutely. Let us know what stood out to you from this discussion. Any questions still lingering? What angles are you maybe exploring further after hearing this? We always want to know what you're thinking.